This is Optimal Finance Daily, episode 1934. How to Create Tiny Advantages and Crush Your Opponents by James Altucher of jamesaltucher.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get right to it and continue optimizing your life. How to Create Tiny Advantages and Crush Your Opponents by James Altucher of jamesaltucher.com. First, let me tell you how you win a game of chess. You'll see why. Rule number 1, make sure all of your pieces are protected. There are exceptions to this rule, but in general, just make sure you aren't leaving anything hanging. That is, in such a way that the opponent can take it without being forced to pay for it. The next technique is the one that most beginners don't know, but it's really important. Basically, accumulate tiny advantages throughout the game. An example is you have your rook on an open file, or you have a less exposed king than the other guy, or you have a pawn that has no other pawns in front of it so it can get to the other side more easily. The idea is that while you're accumulating these tiny advantages, your opponent realizes you're crushing him when your advantage is overwhelming. Now let me tell you how an investor can take the same view on his portfolio. No company or stock is truly safe. I've seen amazing scandals happen and ruin companies very, very quickly. But here are some examples of small advantages you can accumulate until, just like in a chess game, you've put yourself into a better position. You can invest in a stock that correlates with a strong demographic trend, or invest in stocks that have strong investors that also own them, like Warren Buffett. Or one of my favorites, you can own companies that have a lot of cash in the bank and no debt. Note, these are small advantages that add up big, but if you want to start with a big advantage, you can follow my backdoor investing approach. Oh, and I should tell you these guidelines. If a company has a lot of cash in the bank and no debt, then it's not going to file bankruptcy anytime soon. If you want entertainment, it's funny to watch the Yahoo message boards. Many of the people who post there don't understand the difference between a stock and the company it represents. Sometimes a stock will go down and people will start shouting on the boards, "They're going to file for bankruptcy." If a company has no debt, it won't file for bankruptcy. It can only file for bankruptcy when it can't pay its debts. So here's an example of a totally safe stock. This is an extreme. Company XYZ is worth $100 million on the stock market, but has $150 million in the bank. In this case, someone could buy the whole company, shut it down, and still have $50 million left over. That's a ridiculously safe stock. And believe it or not, those situations happen. They were around in 2002 and in 2009, and buying baskets of those stocks proved to be very lucrative. Not all stocks are that safe where they have more cash than they're worth. But some stocks have assets that can be liquidated that will add up to more than they are worth. They might have real estate, for instance. I'm going to borrow from Warren Buffett again. Quote, "If you think a company will be around 20 years from now, then it's probably a safe investment." End quote. For instance, Disney and Google will probably be around 20 years from now. I don't know if they'll go up 500% from here, but they aren't going bankrupt either. Some people judge a company's safety by its volatility. If it stays within $39 to $40 for an entire year, then a stock has very low volatility. But that's just an illusion of safety. It can fall quite quickly in the case of a scandal. I've seen it happen. I've been in the middle of it. It's horrifying. The goal is to find that very unique combination of stocks that could go up quite a bit and also have a good margin of safety around them. There are two sayings that apply to investing. First, those who chase straights or flushes go home on Greyhound buses. In other words, don't buy a stock hoping for a good earnings report as the only way you're going to win on the investment. And if you can't spot the fish at the table, then it's you. There are a lot of sharks at the table: hedge funds, mutual funds, day traders, Mr. Buffett, and so forth. But if you accumulate tiny advantages, you have a better chance of winning. You just listened to the post titled, "How to Create Tiny Advantages and Crush Your Opponents" by James Altucher of jamesaltucher.com. I like to add this to James's list of ways to gain advantage in investing. Don't pick what companies to invest in. Just invest in all of them. It's really challenging to know which stocks are going to stand the test of time. This is why I'm a fan of total market index fund investing. It completely removes all the work around selecting the right companies who will prove to be good investments. This is because index funds are self-cleansing. When any individual holding loses value, at a certain point it will be delisted from the index and replaced by stocks that are performing better. Professional investment advisors make predictions all the time on which stocks will do well based on fancy metrics and poring over earnings reports and evaluating trends. But the overwhelming majority are wrong. According to a 2020 report, over a 15-year period, nearly 90% of actively managed investment funds failed to beat the market. Portfolio managers are often Ivy League educated investors who spend their entire workday attempting to outperform the stock market. If investment professionals can't consistently beat the market, why would I even try? Especially when I consider that I don't need to beat the market to meet my financial goals. I simply need to match the market, and I could do that by investing in total market index funds. And that should do it for today. Have a happy rest of your day, and I'll see you on the Thursday show tomorrow, where your optimal life awaits.